Could we be on the brink of a seismic shift in the American financial landscape? One that could alter the course of consumer banking and lending in profound ways? The recent legal and regulatory changes in the United States credit and banking sectors seem to suggest so. The first of these events unfolded with the conclusion of a legal battle involving Visa and MasterCard. The credit giants settled at a staggering $30 billion over allegations of excessive interchange fees charged to retailers. This settlement not only involved a hefty financial payout, but also enforced a cap on these fees for at least 5 years, potentially altering the revenue dynamics for these credit behemoths. Then came another legal blow to credit card companies, a lawsuit settlement with the Consumer Financial Protection Bureau and the White House over what were termed junk fees related to late payments. This settlement drastically reduced late payment fees from an average of $35 to $41 to a mere $8. This significant reduction in late payment penalties could potentially encourage laxity and timely repayments among consumers. The tightening regulatory grip also extended to the banking sector. A significant shift in approach to overdraft fees was observed. What was once a $35 fee for insufficient funds could drop to as low as $3. This change raises questions about the viability of such fees as a significant revenue stream for banks, especially in scenarios involving high-risk lending. Perhaps the most consequential development was the cessation of the Bank Term Funding Program on March 11th. This program was a critical lifeline for small to mid-sized banks, and by extension, the small businesses that heavily rely on these institutions for credit. The cumulative effect of these changes could send shockwaves through the lending landscape. With reduced profitability from fees and the end of a crucial funding program, banks might tighten their lending criteria. As a result, credit could become less accessible to a broad swath of consumers and businesses. This contraction in credit availability could precipitate a credit crunch, where loans become harder to secure, interest rates potentially rise, and consumers find themselves squeezed financially. The ramifications could be particularly dire for small banks and credit unions. They might struggle to compete with their larger counterparts in a tighter regulatory environment. This struggle could exacerbate the consolidation trend within the banking industry, leaving consumers with fewer choices and potentially less favorable terms for banking and credit services. As these changes unfold, it's essential for consumers and small businesses to reassess their financial strategies. For individuals, this might mean taking advantage of current opportunities to transfer high-interest credit card debt to 0% APR cards, or seeking advice on improving their credit scores. For small businesses, the focus should be on bolstering financial resilience, perhaps by diversifying credit sources, tightening budgetary controls, and preparing for a more challenging lending environment. In conclusion, the recent legal and regulatory changes signal a potential upheaval in the American credit and banking sectors. The effects of these changes could lead to a credit crunch that reshapes the financial realities for millions of Americans. The time to prepare for this financial paradigm shift is now.